Welcome to the Savvy Ladies Wednesday Wisdom webinar. I'm Maggie Montemuro, and I'm the Marketing Coordinator at Savvy Ladies. I would like to remind you that if you have any questions during the webinar, you can type them into the chat box. If you're joining us by phone, please email your question to info@savvyladies.org. Today's presenter is Peter Ramundo Jr., partner at New York Life Insurance Company. Peter focuses on recruiting, training, and developing new financial representatives. Peter is experienced in many aspects of financial planning and personal financial strategies. Throughout his career, Peter has been recognized as a Leaders Conference Manager and Manager of the Year. Thank you for your time today, Peter, and let's get started.
Thank you, Maggie. Good afternoon, everyone. Today's presentation, we want to go through some of the common mistakes individuals make in planning for their retirement. So when we look at where the different buckets of money where you can plan for retirement, there are three different buckets. All right. So the first bucket is a tax deferred bucket. All right. So when I work with our clients, we want to make sure they can understand this. What is the tax deferred bucket? It includes assets where you are not paying taxes now. Those include your 401k, a 403b, a 457, IRAs, defined benefits such as a pension, profit sharing, and also Social Security, where you're not paying taxes on this now. When you do get to retirement, you will be paying taxes. Okay? I call this bucket the government's accounts receivable bucket. All right? Because the reason being is, they're deferring your tax today, but down the road, they're going to hit you with that tax bill. The next bucket is after-tax bucket. And this is simply your checking, savings, mutual funds, stocks, and bonds. You've already paid tax on that dollar and before it goes into the investment. And then afterwards, you will not pay ordinary income tax on that. You will pay a long-term tax rate. Lastly, is my favorite bucket, is the tax-free bucket. Unfortunately, it is our government's least favorite bucket. So they don't give you many choices to be able to put money into the tax-free bucket. Some of the choices that you do have for the tax-free bucket, one is municipal bonds. These are bonds issued by local, state government to be able to raise money. Currently, I live in New York. If my local school district wanted to raise money, they would issue a municipal bond. Municipal bonds are tax-free because they have an agreement with the federal government. You don't tax me, and I won't tax you. Next is the Roth IRA, where you're putting after-tax dollars into a Roth IRA, but when you want to access that money, it will come out tax-free. All right. The problem with that is there are income limits on who can contribute. For a single person is currently around $117,000. For a married couple, it's about $189,000. Also, you can only put in $5,000 or $5,500 per year, which isn't a lot to be able to put away and save for retirement. The last part of the tax-free bucket is cash value life insurance. If it's set up properly, money's coming out of that while you're in retirement will come out tax-free. Now, when we work with our clients, we want them to understand the differences of these three buckets and how it will affect your retirement. But also, what we want to work with them is to how to create flexibility today, tomorrow, and in the future. So we work with our clients to set up, these are the tax rates you're seeing on your screen today. We're going to use this for our example, 30% tax rate for your tax deferred bucket, 15% for a long-term tax rate. Sometimes it can be up to 20% now. And of course, on tax-free is 30%, 0%. We like to work with our clients to build a game plan for them, setting them up today of a 40, 30, 30% allocation. And here's the reason why. If you get to retirement and all of your money sitting in the tax-free, tax-deferred bucket, all right, it's not the best place. If you deferred the money and now the government is taking out its taxes, what happens if we're in a high tax rate environment at that time? So working with our clients, we would love to put 100% in tax-free, but unfortunately, it's really not possible when you look at Social Security. Most of my clients feel that when they hear about Social Security being taxed is, what are you talking about? Well, up to, if your income is 35,000 or above, or 44,000 married couple, up to 85% of your Social Security benefit will be taxed when you're in retirement. So as we're working with our clients to do a 40-30-30 allocation, this is kind of what we want to show them as an example. If you start your retirement with a $10,000 monthly retirement income, okay, and you had all your money invested in tax deferred, at a 30% tax rate, you would pay $7,000. You would net $7,000 and pay $3,000 to Uncle Sam. Our next scenario is if we could just shift some of your money, depending on where you're in your situation, from a tax deferred to an after-tax bucket, where you're going to get the benefit of long-term tax gain rate. This way, if you look, now we're going to do 60 out of tax deferred and do 40% of the money coming out of after tax. In this scenario, now 6,000 would come out of tax deferred. At 30%, you would pay 1,800 in taxes. And now 4,000 comes out of the after-tax bucket. At a 15% rate, you're paying 600. By just making that adjustment and moving more, paying more taxes into more assets in the after-tax bucket, is going to save you $600 per month in retirement income. I don't know about you. I would rather have an extra $600 in my pocket instead of it going to Uncle Sam. Moving forward, our optimal, if we could get to 40, 30, and 30. All right, so we're going to be taking 40% from tax deferred, 30% from our after tax, and 30% from our tax-free bucket. So at $4,000 out of the tax deferred, at a 30%, we're going to pay $1,200 in taxes. Next, we're going to take 30% after tax of the $10,000, that's $3,000. At 15% is $450. Lastly, we're going to take $3,000 out of the tax-free bucket. Now there's our 0% taxes, so you're going to net out the $3,000. And all told, you're going to have an additional $1,350 in monthly income than if we have all our money in the tax deferred. All right. So I want to stop there and just go back and review this. There's nothing wrong with the tax deferred bucket. It is the easiest bucket to put money in, from your employer through your 401k, put money in your IRA, you have Social Security. But it's not the end all. I do work with a lot of business owners, with my agents, and even when I'm working with CPAs, they love that tax deferred bucket as well. And it is good for saving money on taxes today. But you also want to look at creating flexibility going through. Well, if your money in your tax deferred bucket, you don't have access to that money. Okay? Taking a loan from a 401k is one of the most common arguments I have. Well, I can get at that money if I need it. But then you're going to be taxed double on that dollar, because they lend you, the participant plan lends you the money. When you pay that money back, you're paying it back with after-tax dollars. And then when you go to take it out again in retirement, you are going to be paying taxes on that again. Okay? So like I said, this helps create flexibility, because if you do get to retirement and we're in a high tax bracket, in our model, you can be able to take money out of your tax-free bucket or the after-tax bucket and let your tax-deferred bucket grow a little while longer until tax rates come down. Conversely, if you get to retirement and we're in a low-tax environment, you can also take your money then out of your tax-deferred bucket, okay, and let your after-tax and tax-free go. Lastly, before I go to finish through our model here, is the tax-deferred bucket is also a very hard account to leave to your beneficiaries, okay? They have two choices. One is to stretch the amount out through their lifetime, okay, using your age for a required minimum distribution, or they will take lump sum, which they will pay up to ordinary income tax up to close to 40 to 50%, including penalties. So when we look back, going through creating flexibility, saving money on taxes while you're in retirement, our example noted that you would have $8,350, all right, which is an increase of $1,350 over having all of your money in a tax deferred bucket, which unfortunately I see many of my clients before they sit down with us are doing. In that scenario, that's an additional $16,200 each year of income for you when you're in retirement. That could be taking grandkids on a trip. That could be you going on a trip, whatever it may be. You might want to save it. If you save it over 20 years of retirement, now we're looking at $324,000 over a 20-year retirement. If we invest it at 6% annually, that's $631,000 that could be in your pocket and not in Uncle Sam's. One of the other last arguments I get on this before we get to questions is when I get to retirement, I'm going to be in a lower tax bracket than I am currently. I'm not so sure about that, and I don't ever want to bet my client's retirement on something that I don't have a concrete answer. Our next slide kind of shows when you're working and you're in a tax bracket, 30% tax bracket, as you see here on the left-hand side, you're getting a deduction for your house on your mortgage. You're getting a deduction on your children, even though they cost you a lot more than that deduction you get. And if you're saving for a retirement in a qualified tax-deferred vehicle, you're getting a deduction there. So if you remember when you get your tax return back, it'll say effective federal rate. And so in this example, we'll say it's down to 20%. Okay? Now, the College of Financial Planning states you want to have 70% of your income when you're in retirement. So maybe your tax bracket when you're retired on the right-hand side of the bracket would be 27%. All right, but now if you look, do you have a house mortgage? Probably not. So you lost that biggest deduction. Your kids are no longer a tax deduction for you. They might be living with you and eating all your food, but you're not going to get a tax deduction. And since you're retired, you're not making any contributions to any of the accounts that will afford you a tax deduction. So what happens is your tax rate is still 27%. So why would you want to put your money in an account, all right, and not allocate it into different accounts? Would you want to end up having to pay more money in taxes in retirement than you were when you were working? Lastly, is there slide adding up when we talked about scenario 1, 2, and 3 on the different amount of monies you would save without any investment income. And you can see 324 over 20 years. Here are the different scenarios. From scenario 2, which is just moving some portion of your money into your after tax where you have more control and it's liquid, to scenario 3, having it in all 3 buckets. Maggie, if you want, we can open it up for questions.
Okay, great. Thanks, Peter. We'll read this first question here. My company does not provide any retirement savings or investment plan. Can I set up my own 401k or IRA?
You cannot set up your own 401k because those are employee-sponsored plans through ERISA, but you can contribute to an IRA or a Roth IRA. An IRA could give you a tax deduction depending on your income and your age, and with your age is how much you can contribute. It's between $5,000 and $5,500 a year.
Okay, great. And another question that came in is, when you say the Roth IRA has thresholds, does my salary need to be greater than $117,000 in order to contribute?
No, it needs, your adjusted gross income needs to be less than that to be able to contribute into a Roth IRA. So the income limits are set for a single person and joint, and that raises the threshold. But if your adjusted gross income is less than 117,000, then you can contribute to an IRA, a Roth IRA. But once it goes above that, you will not be able to contribute.
Okay, thanks. Another question is, on the deduction checklist slide, what's the tax deduction for the 401k?
The dollar for dollar amount goes in, okay? You will get a tax that you will not pay taxes on that dollar. So if you're in your employer's 401k and you put $10,000 in, that will drop your adjusted gross income by 10,000. So you would not pay taxes today on that dollar. You will pay it in retirement when you start to withdraw funds. So you are deferring the tax on that.
Okay. This other one is, should I be looking at this in a different way than how, for example, my mother would look at this? Is time until retirement a factor?
Absolutely. Time is definitely, the earlier you start, the better chances you have to be able to move your assets into start contributing more into after tax and tax free buckets, which will give you more flexibility. So our clients that start a game plan, when they leave our office after seeing our presentation, is they're like, all right, I have a game plan now on how I can set up and invest my money on a monthly basis. The closer you do get to retirement, our hands are kind of tied on how can we kind of move assets around. So the earlier you start, the better.
Okay. And another question is, do I just need one of each of the 3 points on the triangle to be considered fully diversified?
Well, I'm not saying diversified, but there are in each bucket of money, there are all different types of investments that you can invest in. So when you have your tax deferred, the most common that you'll hear of is your 401k through work or your IRA. Okay. On the after tax, it's you have, if you go to a bank, a checking and savings account, a CD, you have stocks, bonds. So when money goes into there, now working with your financial professional, you're going to allocate those to different types of asset classes. Um, Same with you're up into when you're in your tax-free bucket in your Roth IRA. There's going to be certain investments that'll go into that um, based on your risk tolerance and time frame for that. Cash value life insurance, it depends on which type of product, where that extra money will be invested in, and municipal bonds, that is the investment product. But inside each of those buckets, there's many different investment choices for you to make.
Okay. And do you have time for another question?
Yes.
Okay, I have 400,000 in my 401k and am 10 years from retirement. What do you suggest I do to diversify?
Um, without knowing more information, it wouldn't be right for me to. Um, there's so many different variables. There is 10 more years till your retirement. Your 401k, you cannot, you're not touched while you're still working. There are ways to say, if your employer is giving you a match, by all means, you take that match. All right, that's free money. But if you are contributing, say, 17 to 22,000 into your 401k, and they're only matching you on 5, there might be other places where you can put it to try to start moving your money into the other buckets.
Okay, great. Well, we want to thank you again, Peter, for such a great presentation, and thanks to everyone who joined us today. And we hope you'll join us again soon. And thank you again, Peter.
You're very welcome. Take care, everybody. Have a great day.
Thanks. Bye bye.